Hello and welcome to this quarterly update for the Ftse 250. I'll be taking a look at the price action on the Ftse 250 index, and I'll also be taking a look at the various macro factors. Before I start this video, please remember that I do these just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So I like to start with a long-term view where there's a well-established pattern of a certain gradient by which the FTSE 250 went up in value over time. And this is in what was called the Taylor rule period, where only really interest rates were used to try and meet the central bank targets. But then following the credit crisis, we entered this new Keynesian economics period where we definitely see a increase in the gradient here of how much the FTSE 250 went up by. And of course, in the new Keynesian economics period, we see that they started using massive money printing or quantitative easing as a way of meeting the central bank targets in addition to the use of extremely low interest rates. Then, of course, following the Wuhan flu outbreak and the resulting government action, which included lots of more money printing, we had the initial crash followed by this massive QE bubble. And we've had a rather dramatic fall from grace for the FTSE 250 in the years following this. However, zooming into more recently, the last couple of years, did seem to get a double bottom. And from there, we're in a nice all hail new Keynesian economics trajectory here. When I look at this chart and without knowing anything else, it's definitely looking very bullish for the FTSE 250 at the moment. Now, I don't know whether this long term trend line, we're going to continue with that, or whether the FTSE 250 is now more highly geared, potentially because of how much more monetized the whole system is with all that extra quantitative easing. I don't know, but either of those scenarios is possible. But it's either way, it's looking rather bullish for the FTSE 250. So now to focus on the macro, and in terms of GDP growth, as we can see, it's kind of been sluggish, particularly if we focus on the last quarter. But generally, it's kind of slightly sluggish, but going in a positive direction. And using my crude estimate, it's kind of bang on target at the moment at about 2% per year. Here on the longer term view, the GDP growth is the green line, and it's kind of sluggish but returning back to normal, I believe. Unemployment is extremely low at only 4%. Here we see the longer term trend, and the unemployment situation is looking excellent in the UK. And then inflation. Now, most people like to use year on year inflation targets, but to me, that's not very good data. I prefer to look at the month on month CPIH data, and I package this into quarters. And currently, my estimate, which is using 2 times the current plus the previous 2 quarters, have us at about 3% per year inflation. However, when you nail down into the latest last few months numbers, actually you can consider my estimate here of 3% as being a worst case. It's more likely that we are actually bang on target. And here in this chart here, the inflation's the orange line. And as you can see, after the government behavior following the Wuhan flu outbreak, it's now actually looking rather reasonable. Here you can see to compare with that the longer term trend. So actually, when you just look at these key metrics, the GDP growth is looking great, unemployment's looking great, inflation's probably back on target, the stock markets are now doing great, and house prices are kind of hanging in there. So overall, it's not actually that bad when you just look at these core metrics. Now, I like to remind myself using this slide that this amazing trend in terms of the FTSE 250 kind of always going up on a gradient, this has been enabled by this new Keynesian economics, where interest rates and quantitative easing have been used to manipulate the key targets. However, we have to remind ourselves that this was only enabled in recent decades by the growth of technology and the internet and also globalization, which formed deflationary forces that allowed the government to do these cheap tactics without actually causing too much duress on their currency. Now, the inflationary forces that were at play following the pandemic, things like the energy crisis, food inflation, supply chain crisis, all of those forces really have abated. The other thing you've got to remember, though, is ultimately it's all pinned together by having a relatively strong currency. Now, an important factor to that is the fiscal indiscipline of the government. And currently, the government debt is 2.8 trillion, which is 100% of GDP. So here I have the fiscal deficit as a percentage of GDP, as well as the annual fiscal deficit. And we could see, and it's very interesting that we had this changing gradient in 2009 following a load of money printing, and then apparently a change of gradient materializing now following the massive money printing over the COVID crisis. Exactly the same pattern in America, by the way. So here you see how we had the quantitative easing at exactly those two time periods. But then here we see the cost of that, which is the government debt as a percentage of the GDP was massively increased at these time points. However, it's kind of stable. You know, we can say that the current debt levels are kind of stable. So although the absolute numbers look horrendous, it's kind of stable, but it will create a certain level of duress in terms of the strength of the currency. And this is, of course, expressed by the value of the currency versus other currencies and by the yield curve. Now, actually, when I compare the pound sterling against the US dollar, it's actually been strengthening this year. And when I look at the overall trend, it's kind of stable. And when I look at the yield curve, so here I've got the Japanese yield curve, which is what a yield curve is supposed to look at like. Well, our currency is still partially inverted. And because it's partially inverted, that's why I've got it as a yellow here, you know, a yellow flag, got to keep an eye on this. But actually, it seems to be uninverting, which is, of course, a positive thing. And my general feeling is, and of course, lots of people have said we've had an inverted yield curve, therefore we must have a big recession. I see a scenario where all these goings on here were artificial. They were created by the government's actions during lockdown and printing all that money. But now they've gone back to equilibrium. Now they're getting back to equilibrium, and so I can see us getting back to a normal yield curve without a recession. In terms of interest rates, the near zero interest rates we've had for the last few decades, that's actually a bit of an anomaly. When you look at the long term data here, you see that the normal situation is for us to have relatively high interest rates, certainly about 5%. And so for me, it seems obvious that with the economy looking a little sluggish at the moment, in terms of the real GDP growth, I can see some interest rate drops, but only really to between 3 and 4%. The reason being that because of all the fiscal indiscipline, the government won't be able to reduce interest rates more than that without causing severe distress to the currency. And actually, because of the fiscal discipline, I see the yield curves actually increasing on the long end. So it makes sense to me to see the a bit of a drop in a bit of a drop in base rates, maybe to between 3 and 4%, but a slight increase on the long end, and that's how we get back to a normal yield curve. So that completes my quarterly update for the Ftse 250 plus the UK macro situation. Now, for those of you who just want the big picture, you don't need to watch anymore. But for those of you who like a bit more detail, I'll just go through some additional slides. Here we see the net quarterly fiscal budget, and you can see how actually compared with before the Wuhan outbreak, the situation has definitely deteriorated here. And this is an argument for a certain level of austerity, which also kind of might explain higher yields on the yield curve at the long end to a certain extent. The UK is in a bit of trouble balancing its books into a more healthy situation. And here you see the same thing. And interestingly, following the Wuhan outbreak, GDP jumped from 80% to over 100%. It's interesting that there's possibly an acceleration in the gradient at which the stocks are going up. A lot of that being actually inflation related, and linked to that kind of inflation issue. There's possibly we see like a step change from 2020 in how GDP is going up, and of course government debt's going up along with it. And here we have government receipts and spending, where again you see visualized the same as up here, how there's a bit of a austerity, there's some austerity issues perhaps that are going to keep us subdued. It's going to take us a while before we lift off, even if the US seems to have lifted off already. And here we have government spending as a percentage of GDP, and we're obviously a socialist country now, regardless of if Labour or the Tories are in. Now here I've got the retail sales, and obviously being volume, this is actually now looking quite positive, because there's actually an increase of a significant increase in people buying and selling things. So this is actually a good sign, and actually probably a good sign for retail stocks. So you've already seen the long-term interest rates chart. Here we have the same thing for unemployment, where you can really clearly see here how good the unemployment situation is in the UK. And then inflation, um, here's a long-term perspective for that. And house prices, it depends. So you could, if you drew your line here, they're still looking normal and like they're going to go up. However, you could draw this other ways, which would suggest a bit of a disjunction here. And I'd say house prices are a bit of a yellow flag for me. They've generally been kind of doing okay, or at least staying flat. But yeah, this is a bit of a worrying trend. If we don't shoot right back up now to kind of confirm this line, then we have to perhaps more go with this and accept that there might be a capitulation in house prices. That's a definite yellow flag, particularly with the Labour government introducing all these landlord-hating schemes recently. You really have to worry. GDP and empty money supply. Now, when you look at the US charts for these, they're shooting right up again, but actually not really the same for the UK. And this is kind of perhaps another kind of like yellow flag here, and something to keep an eye on. Interestingly, after the credit crisis, we in the UK didn't go shooting up like the Americans. We kind of went sideways, and it took ages before we then started going great guns again. And you have to wonder, is that going to happen again here? So again, this is kind of a bit of a yellow flag, and it's not like one of my key metrics, but this is something to keep an eye on and return to. So that really does complete my video now, and for those who stayed along for the more detailed bits, thanks for staying along. I hope you found this video useful, and speak to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.